EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It is one of the most widely used financial metrics in corporate finance. EBITDA helps investors, analysts, and business owners understand how well a company's core operations are performing. Throughout this video, you'll learn what EBITDA means, how to calculate it, why it matters, and what its limitations are. By the end, you'll have a solid understanding of this essential business performance metric. EBITDA is a financial metric that measures a company's operating performance by excluding non-operating expenses. Think of it as a way to see how profitable a company's core business activities are, without considering how the company is financed or taxed. The key purpose of EBITDA is to focus on core business profitability without the influence of financing decisions, like how much debt a company carries, and accounting decisions, like depreciation methods. This makes it easier to compare companies that might have different capital structures or tax situations. Let's break down each component of EBITDA. First, earnings refers to net income from operations, the profit a company generates. Second, interest represents the cost of debt financing, the money paid to lenders. Third, taxes are the government tax obligations that companies must pay. Finally, depreciation and amortization, often abbreviated as D&A, are non-cash accounting expenses. Depreciation spreads the cost of physical assets like machinery over their useful life, while amortization does the same for intangible assets like patents. By adding these four items back to net income, EBITDA reveals the earnings generated purely from operations. The standard formula for calculating EBITDA is straightforward. Start with net income, then add back interest expenses, add back taxes, add back depreciation, and add back amortization. This gives you EBITDA. Alternatively, some analysts prefer to start with operating income, which already excludes interest and taxes, and then simply add back depreciation and amortization. Both methods will give you the same result. The key is that you're reversing out these non-operating items to isolate the earnings from core business operations. Let's walk through a practical example. Suppose a company has a net income of $500,000. They paid $75,000 in interest expense, $125,000 in tax expense, and $100,000 in depreciation and amortization combined. To calculate EBITDA, start with the $500,000 net income, add the $75,000 interest, add the $125,000 taxes, and add the $100,000 depreciation and amortization. The result is $800,000 in EBITDA. This means the company's core operations generated $800,000 before accounting for financing costs, taxes, and non-cash charges. EBITDA is popular for several important reasons. First, it enables company comparison. You can compare the operational performance of different companies regardless of their capital structure, meaning whether they use debt or equity financing. Second, it provides core performance focus. EBITDA isolates operating results from financing and accounting decisions, giving a clearer picture of business efficiency. Third, it serves as a valuation metric. EBITDA is widely used in business valuations and acquisition analysis. Investors often look at multiples like enterprise value to EBITDA to determine if a company is fairly priced. These benefits make EBITDA an essential tool in financial analysis. Despite its usefulness, EBITDA has significant limitations that you must understand. First, it ignores cash flow. EBITDA does not reflect actual cash generation or changes in working capital, which are crucial for assessing financial health. Second, it excludes capital expenditures. EBITDA overlooks the investments needed to maintain or grow operations, such as purchasing new equipment or technology. Third, it can be misleading. EBITDA may overstate profitability for capital-intensive businesses that require heavy ongoing investments. A company might show strong EBITDA, but still struggle with cash flow if it needs constant capital spending. Always use EBITDA alongside other metrics for a complete financial picture. Let's review the key takeaways. EBITDA measures core operating performance by removing non-operating items like interest, taxes, and non-cash charges. It's useful for comparing companies across different industries and capital structures, and it plays a major role in business valuations. However, EBITDA should always be used alongside other financial metrics, particularly cash flow analysis. It's not a substitute for understanding the complete financial picture. EBITDA is a powerful tool, but like any tool, it must be used appropriately and with awareness of its limitations. Use EBITDA as one component of comprehensive financial analysis to make informed business decisions.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.